right, so today we're going to be covering nothing that involves being a real estate agent, but everything that involves you saving as much money as possible, which is just as important as extra sales. So first thing is, everyone here has an LLC. If you didn't, you would go to sunbiz.org and you go to start a business and you would start e-filing to be an LLC. You can set it up in different ways, but I prefer the LLC. And then once you have your LLC established, you would then go to the IRS, and then you would apply for your federal tax ID number, otherwise known as an EIN. That is an application that's done online. It's very quick and easy. By the time you finish your application, they automatically generate an EIN number for you. And so it is very simple to apply for the EIN online. Then from here, what you would want to do is open a business checking account. You can open a business checking account wherever you like. It could be where you're currently banking. It can be at someplace new. Personally, I'm a big fan of Fairwinds. I've been with them for a long time with my personal and my business accounts. It's easy to transfer money back and forth to yourself. Now they offer Zelle, which is fantastic. Mm-hmm. Second layer of that is a business credit card. Business credit card doesn't have to be with your bank. It could be anyone. Capital One has a great business card. American Express has several great business card offerings as well. And you want to make sure that you're putting all of your income into your business checking account and all of your expenses onto your business credit card. Now, if you have like an auto draft for like your monthly membership here, that can come from your checking account as opposed to your credit card. Usually the business credit cards will have some kind of cash back feature or travel rewards. They almost always will have high interest rates attached to them. So you want to make sure that you're paying it off on a regular basis. So now we're going to get into some advanced moves. First one is going to be payroll. So there are a ton of options out there. Forbes has a list of the 9 best payroll services for 2023. So you think of yourself as two entities. You are the LLC and then you individual. Anything that you pay yourself becomes a deduction. The rule of thumb is at least 25% of your income, but no more than 50% of your income should be paid to yourself in payroll. There are other ways to pay yourself, but the payroll deduction is the one that gives you one of the largest tax advantages. Now, you will be issuing yourself a W-2 at the end of the year, and when you file your taxes, you will have the flow-through income from your business, and then you will have the W-2 that you'll be putting onto your personal tax return. That brings me to the QBI, which is the Qualified Business Income Deduction. And that was signed into law in 2017. It currently is in effect until 2025. It's likely that Congress will extend it. And what that allows you to do is if you are set up as an LLC S Corp, you are able to have a 20% deduction in your qualified business income right off the top. Because the S Corp is what's known as a flow-through entity, if you make $100,000 in your business and you don't take any deductions, that entire $100,000 flows down through to your personal return. At the minimum, the first 20% gets taken off. And so if you have $100,000 of business income, that translates to $80,000 of personal income on your personal return. So you're only paying taxes on the $80,000. So basically that first 20%, that top 20% is tax-free money. And so that was something that was huge. And so in 2017, everyone and their mother went out and incorporated into an LLC S Corp so they could take advantage of this business deduction. I should disclose up front that I am not a tax accountant or a tax attorney or any kind of financial professional. So I am sharing with you my base knowledge and personal experience. And so please contact and consult with a professional. Thank you. So we talked about payroll. We talked about the QBI. Next, we're going to talk about 401k. This is something that everybody should be taking advantage of because there are some incredible opportunities here. So, a self-employed 401k is exactly that. You are able to create your own 401k. There are two companies that I'm familiar with that can help facilitate this for you, and it's way, way easier than you think. One of them is Fidelity, and the other one is Vanguard. And so if you are an individual, sole proprietor, or a single person LLC, or in business with the spouse, you are eligible to get an individual 401k. It's also known as a self-employed 401k or a solo 401k. Those are all the same. And again, you can contribute more than if you were to work for an employer and be a W-2 employee. And you can contribute in two ways. You can contribute as the employer to your 401k and as the employee. So think about a traditional organization where the company matches a certain percentage of what they're giving you. Same concept. You as the owner of the company are able to contribute to your employees' 401k, and you as the employee are able to contribute to your own 401k. So it gets to be really kind of like metaphysical when you're thinking about how it all works. As the employer, you can put away up to 25% of your compensation, not to exceed $61,000 total for 2022 and $66,000 for 2023. That 66,000 is a holistic number. That's the total number of the contribution that can be given in a calendar year to an individual from the employer and the employee. So an employer can contribute up to 25%, and an employee can defer up to 100% of their compensation, up to $22,500 for 2023. So what that means is, let's look at an example. You pay yourself payroll. You can take 100% of your payroll and put it into your 401k. The reason you would do that is because it's an advantage of you as an employee not to have any taxable income on your W-2, because you can put all of it into a 401k. Now, and then as an employer, once you've reached that 22.5 threshold, as an employer, you can throw in a lump sum at any time to get to that 66,000. So again, this is a way for you to put money in, and every dollar that you put into retirement is a dollar that doesn't get taxed in that current year. And so it's great to save. It's great to save on taxes this way. Now, for those of you, don't raise your hands, that may be over 50, there is an exceptional advantage for you because you are able to contribute even more. So now if you're over 50, you can contribute up to $73,000 total. So those are kind of the same as like an employer would offer catch-up payments.
So on the employer side, they can contribute up to $73,000.
$73,000 is total. So from the employee and the employer together,
okay,
they can do up to $73,000.
That's a lot of money in 1 year.
It is. As an employee, if you're over 50, it's $30,000. So that means the company can contribute the other $43,000 together. And so it's important to know these limits because you want to be able to strategize how the money gets distributed. So I recommend personally that you pay yourself quarterly. There's no need to pay yourself monthly, because you in addition to paying yourself, you are allowed to take distributions from your company. So you can move money over from your company into your personal account. That will get taxed at a different rate as your qualified business income. But and then once you've created this 401k, it's like you sign 3 forms. And again, it seems ridiculous because it's like, I, Richard Alpizar, am the owner of Richard Alpizar LLC. I am the sponsor of this plan, and I bequeath the plan to my employee, Richard Alpizar, and I sign, and it all happens, and it's comical, but that's what you got to do to remain legit, and then you can start to invest. Vanguard and Fidelity both offer a multitude of investment options. And so once you start putting money into your 401k, you can invest in mutual funds, bonds, ETFs. You can do what are called target dates. And so like if you're targeting a certain retirement date, it will automatically put a plan together for you that maximizes your return based on your retirement date. There's a lot of options there. And then again, if you call Vanguard or Fidelity, they'll be able to walk you through the options. And just like with any other 401k, the rules for withdrawing are the same. It be 59 and a half. You can take out some money with penalty for certain reasons. You can't loan against it, blah, blah, blah. So that money is all tax deferred. And so you don't pay taxes on any of it now. So it grows. You ever put more money in, it will grow, and then as you take distributions, you will pay tax on whatever your tax bracket is at that time. So most people, when they retire, are making less money and in a lower tax bracket than they were as opposed to when they weren't retired. And so again, that's a great tax accountant question to ask them. You do have the ability to do Roth IRA contributions, and that's indicated here. So Roth IRA is a Roth contribution. It means you get taxed on the money first, and then that money goes into your Roth account, and it grows tax-free. So that is cool to have, but the Roth limits are very low. I think it's like $6,000 or $7,000 a year is all you can put into a Roth. And so if you're really trying to maximize your savings and lower your tax implication, this is the way to do it. The other thing that's fantastic about it is that there's nothing that says that you can't make all of these decisions in December. So you can see how your year goes, and then December you can pay yourself one lump sum check in payroll, and you can put the rest of the money as your contribution to your 401k, and that way you're not wrong about having overcommitted to something. And so that's why I think the quarterly way is the way to go. Brings me to my next topic, which I've seen a lot of very intelligent, successful people get in hot water with the IRS. You can owe people money, but you don't want to owe the government. And so you want to make sure that you are making quarterly tax payments. So once you have an LLC established, you need to be making quarterly payments, and that's calendar quarterly, to the IRS for what your expected tax liability is going to be. Now, you might be asking yourself, how do I know what my expected tax liability is going to be? And the answer is, you're gonna have to guess. And if you guess, you wanna guess high, because if you happen, at the end of the year, if your tax liability is $20,000 and you've only put in $15,000 in your quarterly payments based on your best guess, you will pay a small penalty on that $5,000 that you're short. Do you get interest for the money that you put in extra? No, of course not. It's the government, so don't expect that. And then also, once you have a history, you need to be making sure that you're putting in at least as much as you put in last year. So if last year you put in $20,000, this year you may have to make sure that you're putting in at least $20,000. And then if you make more than you did last year, even more than that. So you want to make sure that you're being very conservative with the taxes. Don't get behind on them. I've seen people that made a lot of money and they owe the government $40,000, and then you get behind on your payments, and then you're still the clock's running. You have quarterly payments for the following year that you still need to make, and you owe from last year. It can be really, really ugly. You can buy a car in the name of your LLC. If your LLC is new, you likely haven't established business credit. There is a business credit reporting agency. Does anyone know the name of the business credit reporting agency? I can give you a hint. It's not Equifax, it's not TransUnion, and it's not Experian. Anyone? All right, good. Well, it is called Dun and Bradstreet. They are the only business credit reporting company. And then you have a DUNS number, DUNS number, and that is your credit number. Once you have established your EIN and you have a credit card, you have bank account, you have a good track record, your DUNS score will increase. Now, if you want to go buy a car and you don't have any business credit established, that's okay. What they will likely do at the dealership is ask you to be a personal guarantor on the loan, which is fine. It doesn't affect anything else. As an LLC, you can purchase it cash, Tara, and put it in the LLC name, no problem. You have a couple options at that point. If you use, now the caveat is, in any of these cases, you have to use your vehicle for at least 50% business.
Okay.
The IRS is going to require you to keep a mileage log of some sort. Mm-hmm. Whether they ask you for that log in the future is not clear, but they can. So you want to make sure there's an app that's called Mileage IQ you can get. And then it's kind of cool because it tracks everywhere you go. And so if you leave your home and go to here, the office, when you get here, I'll ask you, is this a work trip? And you just click yes, and then it keeps that all set. And that is a perfectly acceptable way of tracking mileage for the IRS. They accept those logs. A couple different ways to slice it. So if you buy, let's go back to the cash scenario with Tara. You can buy a car cash, and you can do one of two things. You can take what's called a Section 179 deduction. That deduction will be based on the amount of use that is used for business and the weight of the vehicle. Yeah. It's got to be at least 6,000. It's got to be over 6,000 pounds. Let's look at the Section 179 deduction. And in some cases, you can deduct the entire expense of the car in the first year. So if you spend $30,000 on a car that you buy cash, you can put it in the name of your business LLC and then count that as a $30,000 expense for the business. So that it allows you to lower your current tax liability rather than depreciating it over time. In addition to that, you can also take your real expenses, not mileage, but you can take oil changes, gas, tires, brakes, things of that nature. Those are also qualified business expenses in addition to the cost
And you
of the
can
car.
do that. You can do the real expenses.
Yep.
Just not the mileage. Okay.
Correct.
Can you look at the mileage at the beginning of the year and the mileage at the end of the year and take 50% of that mileage?
Yes, if you can prove, you'd have to keep they would want you to keep a log so that you can prove that you actually use it for 50% for that. It gets a little more complicated if you decide to do option number 2, which is you buy the car cash and you lease it to the company. So Tara can buy the car cash. Tara, the person, can buy the car cash and lease it to Tara LLC for whatever you want. So you can lease it to the company for $600 a month. It gets a little complicated because you'll have a $600 a month business deduction, but then you'll have a $600 a month personal income. And so you have to decide which is worth more to you at that point. And then the amount of the lease is going to be, the amount of the lease that you can take as an expense is going to be a direct proportion to the amount that it's used for business. So if you use it 100% for business, then you can take 100% lease payment deduction. If you take 75%, then it's 75%. So again, this is where it gets really complicated. But the payment, if you lease, the payment can be used like that. So this is another really cool thing, because in addition to this, you're gonna wanna have the insurance and the LLC as well as a liability shield, so that if you do get into a fender bender, they are suing the LLC's insurance policy and not you as an individual, the insurance policy.
Do the